Hi, I'm Harry. If you might not be able to tell, I'm British, so A, apologies for Brexit. I can't stop apologising for that. B, my accent's quite thick, so if we need to clarify anything, if I go over anything too quickly, just let me know afterwards. Okay, so why am I best placed to talk about venture capital? I've been a VC for the past 7.5 years. I've been at LVP for the past 5 years. I started off actually in tech VC, investing into anything and everything within tech. Seed Series A companies from e-commerce to fintech, insurtech. Even did a hardware company, system on a chip monitoring. And then moved across to LVP 5 years ago, and I'm a principal here. Venture capital itself, I'm assuming that you know some level about or something about venture capital, that there are the foundational elements there, but essentially venture capital, it's a form of private equity financing. You take a stake in usually early companies that they've just been founded. 30% of the companies we've invested into were pre-company formation and registration. We'll take a slice of the company, an equity stake. Usually, for the most part, venture capital is minority. There are some people who are a bit more aggressive, but we'll put in money, and then I'll go on to exactly how we are unique. But at least for us, we also provide other forms of support, which I'll go into later. But moving on with the show. Okay, there you go. So why are we able to talk about venture capital? Probably because we pioneered it. We were the first institutional fund focused on gaming. This was about 15 years ago. There were generalist funds who dip their toe in, usually at the late stage, where there are games in market, there's product, there are metrics, there's revenue to go off. But there was really nothing at the early stage proper venture capital rather than, say, private equity. And the thesis was twofold. One, that tech VC was scared of gaming, arguably still is, especially post financial correction a couple of years ago. And then the second being that we can help out companies, that there's a lot of great gaming talent within the industry. Often people had never started up their own company. There wasn't necessarily that culture. There was the publisher-developer mindset. And the background of LVP, the partners, as well as now our 15 years experience, means that we're able to basically best position ourselves to help companies with hiring, product strategy, game feedback, fundraising, business development, you name it, we get involved. So we started off 15 years ago. We had some good early investments into Unity, Supercell, Amplifier, Playfish, and that helped build out the model. We're now on our third fund, which is 80 million fund, and we're now closing on our fourth fund that we'll invest out of. Had 19 exits during that time, 61 investments in total, 580 million raised of those investments, and roughly 30 billion in equity value created by those investments. I'll move on to the process of at least how we work, and also is probably representative of how most VC companies work. But we assess thousands of deals, and we're spread across 2 different continents. We've got Europe, and then we've got North America. So here's the team. I gave a little bit of background as to how we were formed, but it was essentially the 2 Davids. David Gardner, who was employee number 11 at EA, he dropped out of college to join EA. He scaled the business in Europe. He was the first boots on the ground in the UK and built that from nothing to over $1 billion a year in revenue. And David Lauke, who was one of the founders of Criterion Software, which developed Renderware, Need for Speed franchise. They were acquired by EA. Early precursor to Unity, which actually led to us investing into Unity. He was board director and non-exec chairman for a time at Unity. And then we've since then bolstered the partnership. We've got Ara, who is in Berlin. He was head of studio at Playfish, head of basically Western studios and operations for Gumi. And then Matt Bilby, most recently, who's out in Vancouver. He was COO for Worldwide Studios, in charge of FIFA for a while. And with the fourth fund, he'll come on board as a general partner. there's me. I gave a bit of background onto myself. We've got 6 in the investment team overall, including Gus, who's new analyst. And then we've got the operations team who help support the fund and the day-to-day administration. For people who are wanting to reach out to us, I mean, any of us are fine to reach out to. We've got a form on the website. I'll go into exactly how you should position yourself and who to talk to, but the yellow highlighted ones are the people who actually do the investments. So please reach out to us rather than the green or teal people. They appreciate it, but they don't do the investment. How does a VC operate? There are the 3 S's, essentially. There's sourcing, screening, support. So on the sourcing side, we've got, as I said, over 1,200. That was last year, probably higher this year, on a prorated basis. And that's based on, are they pre-seed, seed? Are they gaming? Do they have the ambition level? So actually, that's a smaller subset of all the deals that we see. Again, the deals that we evaluate, and this is properly evaluate, where we have at least one call with them, is probably close to 70 now, that we go through that process with those companies, and then that's resulted in around 29, 30 active investments that we have along the bottom. So we source those deals, we evaluate, do we want to invest, should we invest, and then once we invest, we support them. Then as a bit of a background as to capital and VC within gaming, as I mentioned, there was a period of time before 2012 where nobody was really investing into games, or if they did, it was very much at the late stage, or it was angels or people who actually knew about the games industry who put money in. It was the idea that games are a hits-driven business, which is ironic given venture capital itself is a hits-driven business. There's such a high rate of failure that you need to have companies that can 10x. And the magic, at least what we pioneered, was diversifying a gaming portfolio so that we diversified that risk so that we could get exposure to those winners. Then I think with mobile, that really brought the attention of gaming to a wider audience. Gaming was able to benefit on that wave of adoption of mobile. And then over probably the second half of that decade, there was a greater abundance of capital, partially driven by low interest rates, but also a lot of people flocking and at least seeing what we had pioneered and done. Within venture capital, within gaming, there were, of course, the esports, metaverse, crypto, hype cycles. There's also now a little bit with AI, which, again, I'll go into later. But all of those also meant that there were these specialized funds, even within gaming, that only focused on VR or crypto or esports. I think now there's been this reset, which is the next phase. It's difficult for them to deploy and also at least have a long-term sustainable future, given the size of those markets, or should I say sub-markets. And then where we're at now, after a couple of wars now, we have inflation, high interest rates, increased cost of capital. This affects VC and the financial markets. Limited partners, I invested into VC firms. Unfortunately, I'm not obscenely wealthy, or at least not yet. We have to raise from other people. Those other people, usually public companies or asset managers or pension funds. They're able to get higher returns basically by throwing it into bonds. It's less risky. So there is that added premium that is required for VC. And so therefore there's a reduction in what they allocate to VC, and that's hit basically all private financing, as well as the fact that there was definitely, within the hype cycle, animal spirits, people following on thinking that, there'll be somebody else who will bail out this company, that they will do the next stage of financing, even though I'm not properly assessing this company. And so what happened was there was a wide-scale collapse in growth financing for late-stage companies where there are products in market, there is revenue, as well as the multiples that you get on those investments reducing in line with what was happening within the public markets. In 2023, investment within the games industry dropped by 79%. A lot of that was driven by crypto and metaverse completely collapsing, but also there were spillover effects into what are classified as more traditional gaming spheres like PC and mobile. And of course, they've had their own challenges, which I'll go into now. So setting the scenes, I'll probably set up the challenges. I don't want to say where I think the market is going, A, because I'm not a founder and therefore I don't have to, but also B, that is the role of the founder, that's the role of you, to come and pose actually solutions to these challenges. I think the big one, at least within traditional platforms, this being PC, mobile, console, is distribution. Distribution is king, and these markets are saturating, and they're saturating very quickly. So we've got two charts here, one on PC in terms of the percentage of revenue generated by the top 10 publishers on Steam. So as we're seeing, there's a calcification around the larger incumbents and those people who've got larger games. And that's gone up 22% between 2022 and 2023, and it's actually similarly happening on mobile. And I think the more problematic thing is also there's not a change in those charts where business models are moving from premium to games as a service. Those incumbents, or their franchises, those publishers aren't moving down and up. It's the same publishers who are capturing more of the revenue. Again, here's more of a theoretical framework where this is what happens to most platforms. It happened to social gaming, it happened to console in the early days. But this is also what's happening with PC and mobile. So there's the content supply, which is increasing. Amount of user time has increased. Revenue has gone up, but then growth rate has started to tail off just because supply has started to meet demand. This is driven now without more fundamental innovation to a quality race that's just higher budgets, especially for AAA. You look at Spider-Man 2, and I think it's just wiped its face once you take into account marketing spend, even though it's hugely successful. They're really successful and critically acclaimed games last year that will maybe again just return what they'd invested in, which just shows how much costs have gone up and the amount of content as well as quality that is required. It's harder to also have those viral moments. Maybe for smaller indies, you can leverage streaming, but for the most part, you do have to expend a lot of money on marketing, both during launch, but then also before launch, building up that community. And then that just increases risk for us as investors, thinking, okay, how much capital, how much money is required to scale this sort of business? What are the margins that we can expect? Mobile, because there is performance marketing versus, say, PC. That's led to a race to the bottom where a lot of people are competing. It's a bit like game theory. Everybody is competing, pushing up CPIs, and so it's almost incumbent on those companies thinking, how far down the line am I wanting this payback to be? I invest into this user and I'm getting maybe 2 years, 3 years. This is a couple of years ago with the casual market and Match 3 that they were spending on those time horizons. And that makes it extremely difficult for startups with limited resources and marketing funds to compete on that sort of level. So at least within our own portfolio, there were some games that were good, but they couldn't compete with the amount of marketing spend that was being put into the market. And then that just leads to innovation, and then the cycle repeats. Especially for those companies in the market, there is little incentive to move. It's the innovator's dilemma that they're happy recycling their own revenue into existing games, building those out, rather than having the risk of launching a new one and losing all that money. So I've set the scene as to ourselves and the wider market, but what exactly do we look for? And I'll talk through a little bit of the process of what we assess and how we analyze companies. And then I'll go into some recommendations for either common mistakes or what I think you should do in terms of structuring if you are going out to market and fundraising, how you do that. We have 5 main pillars to evaluate companies. The first is fit with us. Are you ambitious enough? Do you want to build a $500 million plus business? Are you at the right stage? There are companies that still come to us and ask, oh, we're raising a 50 million round. Do you want to invest into us? We are a seed stage fund, so we put in check sizes between 500K to 2.5 million. There is some flexibility above and below that, but often people come to us without actually necessarily researching our portfolio, how we operate, and then also getting stuff that isn't within gaming. I don't have to tell you about it because hopefully all of you are gaming people here, but a number of just random reach outs from people who aren't within gaming is quite incredible. Then we go on to market. Is this a fundamental innovation? Is it opening up a new platform? Is it a growing sector? Maybe it's geographic, maybe it's genre, maybe it is on platform. What opportunities are there to leverage go-to-market, that you have this community early on? What do you have to prove that in terms of data? And that actually overlaps with the team. What is the required domain knowledge for this particular company? What is the ambition level for them? Have you worked together before? Have you founded companies or built games before? There is a definite risk of people who haven't either built companies or built games before, that there is almost like a 6-12 month first pancake where they actually figure out, okay, how do we construct the right team? How do we build a game? Which we have helped out with before, but that's just another layer of risk. Then there's product. What is the game like? What are the monetization plans? We don't have to see any first playable or any prototype. It's nice. I get to play video games for my living, which is great fun. But when we invest, I think the majority of our investments have been a couple of people in a pitch deck. That is really all that's required. Then moving on to the financial opportunity, which was alluded to within the fit. What is the required capital to bring this product to market? Maybe it's a game, maybe it's platform, maybe it's tech, maybe it's services. What is the price of the deal? How much are you looking to raise? What is the exit valuation? What are the comparables of any company that is similar to yours exiting? Because we are investors, and I'll come on to it later, but at some point we do have to make some money back. And then the box below really shows us the difficulty of how we invest, because we have so many failures that we need every company to basically be a fund returner. So with an 80 million fund that we have, 15%, that's a generous assumption on ownership. We require a 500 million exit, because most companies will fail. Around 70 to 80% of VC investments will go to zero, or they'll 1x. So you require the winners to really be knockout hits and to be home runs in order to return all the capital that you've lost. Common mistakes. This actually relates to what I was just talking about before. I am not a big, I am a VC stan, but I wouldn't say that VC is right for everybody. I think it can be wrong for people, and I've seen how it misaligns incentives for a lot of companies, that they're encouraged to scale too quickly, go down routes that they don't, or they shouldn't really go into. There are businesses that can sell for 20 to 30 million and be life-changing for companies, but that isn't the kind of company that we invest into. In those cases, look for grants, non-dilutive funding, debt, publisher money, keep the equity, and don't let VCs push you into something that you don't want to do. Again, 100% of that versus maybe a smaller percentage of zero where VCs push you down a track where you don't want to go. And also you'll take up maybe 5-10 years of your life. It's something that you do need to think through thoroughly. That's a nice segue onto publisher pitch. A lot of pitches that I have got, people are trying to straddle both sides. I hear people give me a publisher pitch rather than an equity pitch. It's only about the game that they're building. It goes into the lore. I love that. Fair enough, but that's what people are leading with, and they don't talk about what the underlying company is, how these games link together. If this game fails, what do you do? A publisher doesn't care as much about that. Maybe it cares if it succeeds so that they can own the IP rights and sequels. But we are investing into that underlying company on a 5-10 year horizon. We're assuming that most games will fail. Even the best developers probably have a hit rate of a quarter in terms of being really successful. So we're really coming into this assuming that your game will fail, and that's fine. But it's working out, okay, what will the second game be? How do you leverage those learnings? How do you build basically an effective team to jump off into either the second or the third product? Exit aversion, we are long-term investors. We've got a 10-year horizon, but at some point we do have to exit. It's not, we don't require that you come up with ideas now, but there needs to be some acceptance that we will jump off at some point. But hopefully after 10 years, it will be realized whether this company can really do well, that hopefully it will be meaningful for both you as a founder and for us. But that's just as a heads up on VCs that they will expect for there to be some realization. Then another game company, just a lot of pitches similar to the publisher pitch where we're doing this game, but we're slightly tweaking it, or I'll ask them about, oh, isn't this similar to this game? And not having sufficient reasons for why this failed in the first place, or what will change about why you're building this. And then for us, think about like the next, if we're requiring the 500 million exit, what is the enterprise value of another game, and often within a competitive space? Can that deliver a $500 million return for an incumbent? I think it will be challenging without it being fundamentally innovative and new. Again, similar to the lifestyle business, you can get a decent size return, decent style business with that, but there's also higher execution risk if it is just another game or it's comparable or very similar to a number of games in market. Then finally, buzzword bingo. It was worse a couple of years ago where everybody was throwing blockchain and Web3 onto game ideas that were that hadn't succeeded before and thought that these were things to unlock them. There's a bit more fire within the smoke of AI, but again, slapping on a label with a new technology without having some first principles thoughts as to why this changes the value proposition and why this unlocks something is one of the challenges that I find when people just say, oh, it's AI for this. And often these people who have slapped it on don't have the backgrounds. They're looking to just raise the money rather than thinking, okay, how does this affect our business? Okay, and then running through the why, how, what, and do of funding. The why, as in why are you doing it now? How are you? How much are you raising now? How much is required in the future? What is the time between those raises? What are the milestones that will enable you to deliver? and raise on that traction. How much dilution are you taking on that? I mentioned that before. And the valuation that you can command as a company relative to the amount that you're raising. And then also just time. A lot of people take 3-6 months, and that is probably on average to raise. So trying to minimize that where it will distract you, and it can distract you from doing your job, which is operating a business and building a game, building a product. The pitch itself, there is a bit of salesmanship involved, and the Americans are unfortunately still better at it than us, so I'm wanting us to be a bit less humble. We look for that ambition level on the kind of billion-dollar company side, and so therefore we need to see what is the wider vision for this company, where do we hope to be in 5-10 years, what are those stop-off points where you're able to raise more money, how do you craft that narrative to bring on the investor early on and convince them that this is worth their while. It's definitely better to be Marmite and loved and hated and be controversial rather than everybody accepting, oh, this is a good idea. Because often the thing with good ideas is why haven't they been done before, or that they probably have been done before, being honest. 15 minutes. Capital source, how are you raising the money? Is it through VC? Is it through non-dilutive funding? There are lots of grants out there and tax reliefs. If you're going through the VC route, usually that will require somebody to lead. They price around, they set the terms, they go through the legals. There'll be somebody sitting on your board, so you've got to work out, okay, who do you actually want on your board? There have been some companies that I know who have regretted rushing to the finish, and they've ended up with an investor on their board who just doesn't understand games, and they're building an MMO, and they'll ask, oh, how does Candy Crush relate to that? And you want somebody who can help you. It's fine enough if you want to basically get the cheapest money around, but accept that there are some disadvantages of that. And if anything, there can be consequences down the line where they push for an exit because they don't understand what's happening, and they lash out and potentially try and remove people from the company. Then execution, this is just the literal process of the fundraising. We have a process with our portfolio companies where we get a big long list of the investors that we know. We do some early tests, and I'll cover it in the next slide, as to the pitch and getting feedback, and then working out the waves of who you go to get feedback, then the burner group of people that will provide good feedback, but you don't mind too much if they don't come in, then the people that you really care about, who are more conviction-led, and then those people who are driven by FOMO, fear of missing out, that they will then try and rush to the finish, and you're able to get a bit of competitive pressure amongst them all, and related to the raise timing, ensuring that that is as compressed as possible. You don't want to be stale bread on the shelf, that there is that signaling of, oh, you've been raising for many months now, why haven't you raised? And VCs are quite, not necessarily irrational, but driven by heuristics. And so those kind of mental signals can be off-putting for any investor. Then tips, just go big or go home. If you're pitching to VCs, don't feel shy of selling yourself and selling really what you want to build. Keep it simple and throw out the big thing early, and then you can explain how you get there later on. The number of times I've had very smart people over-explain things to me and get unnecessarily bogged down in the detail. It's quite astounding. I want to understand where you're going, and then we can pass out and break through how we get there in the first place. Because more often than not, when you're digging through the weeds, it's then harder to express and say how you'll get to the big point in time. Do your homework. work out the funds that you're pitching to. Do they have other investments in the space? Are they directly competitive? Do they have particular theses in that area? That's usually a good sign that they have expressed, oh, we love co-op, we love gamified apps in this particular sector, and then try and target those VCs. And then also be able to respond to questions on who are the competitors, how do you differentiate from them. Then delivering on when you make promises. This goes to the credibility point, where you said we're going to do this within this time frame. Actually following up on that is just good hygiene, really. And that gives us confidence that you're going to be able to execute over the longer term. We extrapolate that out on the milestones on the budget that you've set out. Warm intros, again, VCs are heuristics driven, and a lot of them are lazy. And so the easier you make their lives in terms of getting that intro and getting a warm inbound, i.e. that you reach out to people who know them, or if you know people who know them, getting those intros, it sets up almost a better call versus being completely cold, just reaching out directly to them. By having that warm intro, it shows that both you're well connected and also that you're tenacious and you're able to network and get that intro. Then, as I said, Marmite, get somebody within a VC firm who loves it. There's a slow death of people who say, oh, it's a good idea, but I've got these questions. You need a couple of people to really love it in order to drive that within the firm. And you don't want to spread yourself too thin where nobody knows who owns it within the VC firm. Then on the deck, have a smaller deck to send across and then go through the larger deck in detail on the call. That helps provide the momentum of, okay, this is moving forward, that there isn't this stall in communication after the first call. And then also you don't give everything away with the first email. Focus on smart money if possible. That's just a general ceteris paribus. If you've got two VCs offering the same term sheet, then you would prefer to have somebody who's able to support you best, be able to introduce you to other investors or to other games companies, other portfolio companies who will be able to help you out. Getting a term sheet, that's probably the main thing, because then that will drive both the followers, people who will come in outside of the lead to commit to the round, and or you're able to take that and raise from somebody else. I've mentioned general hygiene, and then just avoid those common mistakes or have explanations around them if you feel like you're straying too close to those. That's it. There's my email if you want to reach out to me. I'm also here until tomorrow, and I've got a turn the tables slide, because we do a lot of DD on you. You should do DD on us and work out who you're getting into bed with. So just researching, working out who are their portfolio companies, what have they done, how do they best support the companies, and also just reach out to our portfolio companies. Some of the best deals that we've done have come because people have reached out to our portfolio companies and then referred them into us. They're very open to talking about both their own journey and then also us. You'll be surprised at how much information you can get by just asking and reaching out to people. And that's that. Thank you very much.
Thank you, Harry, for your lecture. It was full of very interesting information, and hopefully everyone will get something for themselves from it. As we know, if you don't know what it's all about, it's probably about money. So thank you once again. If any one of you have any questions, please come up to the microphone and you can ask directly Harry.
What do you mean saying that we have to think about smart money? Another question, is it about finding a private investor also to the company, or loan, or Before, I mean before VC, right?
Yes. Yeah. No, it's a good point. Okay, I'll take the former first on smart money versus the comparator, which is dumb money. Smart money tends to be where there is support beyond just financial. So dumb money will throw money in, and that's about it. You'll either never hear from them at best. At worst, they will try and meddle in the business that they have no idea about. So that was my point on smart money, that smarter money either knows where to support companies or basically stand back where these are already experienced entrepreneurs, or you already know how to build the game, and that will be able to help with other things like introductions to late stage investors or publishers. So as for indicators of smart money, again, just talk with portfolio companies who've been invested into by those VCs. Also look at the background of the investors. Have they invested into games before? Have they operated within games? Then as for your question on private financing, we only invest into equity or equity investments. So we'll take a percentage of the company. We don't tend to do loans. You can get loans and stuff on top of equity, like venture debt. Starting off, a lot of our companies have basically just raised directly from us, or they've had friends and family put money in just to get things going. But there are lots of different options out there. You can take loans out early on if that is what is required, but it's not necessary often, because you can get grants and other forms of financing. But it is a good way of probably, once you have a larger balance sheet, to extend that, but also just keep an eye on the terms and especially interest rates, because those can rack up and you can end up having to pay a lot more back than you got in.
And this is somehow connected with the smart money, because I understand that you are a smart money investor, and you mentioned that you are providing the support to your portfolio company apart from, just providing them with the financials. And could you elaborate on the support that you are providing, and how are you an active or smart money investor?
Yeah, that's a really good question. I don't want to take up too much time, but we have an annual summit where we basically bring the great and the good, our portfolio companies, as well as leading industry figures. So we had like Lars from Embracer, with Chris and Sega Strala, Frank Jabot from Zynga. We have big publishers, big investors, and we brought them all in together. Even at the early stage on game ideation, one of our portfolio companies, Based Author in Denmark, they were building out their early prototype of the game, and we pulled together a brain trust. So we had Hilmar from CCP, a couple of other people within the portfolio, some outside who are experienced in MOBAs, to give feedback. But then also we help out with hiring if you need another person to sell, because especially with small companies, it's a bet you're not going to get, if you're a potential employee, you're not going to get paid nearly as much as you would at a larger company. Some of that promise is in terms of options that this company will be able to realize the vision, and it's highly risky. And so we've helped sell that, as well as assess the right candidates to come on board. And then when it comes to exits, we know most of the main people when it comes to that. And so we have helped out where founders have wanted to exit with introductions, constructing that exit. I'll stop there because I don't want to sell LVP too much.
Okay. One more additionally, because maybe I didn't specify that. Asking about smart money, I think I thought about what's your what do you think about company where there is some private investor or family, friends, fools? It's okay, but when there is some private investor, are you also investing in such a company, or it's yellow or red light for you?
Sorry, just if I can understand the question, if there are existing private investors in the company,
Yeah.
is that a red? No, It depends on how much they own of the company. I've seen some bad deals where they've taken the majority of the company. It means that it's very difficult to raise further funding later down the line because the founders have got little incentive. Future investors will want to ensure that they are incentivized, and that will lead to a recapitalization of that company, i.e. the people who invested, if we were to invest, we'd get diluted down from that. We'd also look at who the investors are. I think it's understandable when you are raising money that you raise from local investors. That isn't too much of a big deal, but I think it's just understanding the why you raise from them, how much, and what percentage of the company they own.
Hey, Harry. Borislav from Indie Studio in Serbia, and we're looking for equity investment technically. And I want to get your perspective on superstar teams versus new indie teams with really solid business foundations and advisory boards. Like, where do you see your tendency leaning towards?
Yeah. That's a really good question, especially now, because we've seen some flame-outs of superstar teams. I don't think those two things are mutually exclusive. You can have the superstar teams that you invest into. Often you're requiring the right price, but versus, say, the solid indie teams with maybe they've got a product in market. I think there can be some decent returns that can be realized, but then it's working out, okay, what is the entry price for us investors where it makes sense? Can this 5-10x the company? Is there that exit route that is viable? So there have been a couple where we've invested into it, and it has been prototype / vertical slice stage. So we invested into Steel City Interactive, who actually, I don't know whether anybody watched boxing a couple of nights ago, but they built a game called Undisputed. That was indie team there, scaled to 20, 30 people plus, and we invested into that. I think there are great opportunities on both sides. With experienced people, there's lower risk on execution versus, say, the superstar, where it's a lot more volatile. Maybe they'll go to $1 billion. More often than not, they will not. So we actually have a bit of a mix between the two, and in this environment, I think some of the more traditional or experienced indie teams can have an advantage. As I was saying, in a mature market, execution risk is all, and how do you get to players? Maybe you have an existing community that you can build on. You don't need to learn on the job with the games that you're releasing. We've had pitches where they've released a game in one genre and they're able to build from that. There's nothing that drives learning more than having a game in market and everything being on fire. So that it's quite nice to actually see somebody who's been battle hardened by that. And then even with the superstar teams, they're often expecting a team of 40, 50 to coalesce around them, if not more than that. And that often leads to it becoming project financing rather than VC financing, that it's all on this one game. So I've kind of talked around your question, but I was trying to outline like the pros and cons of investing into both. I think both are viable.
So I'm going to take a step back to your first word, demystifying venture capital. So I come from an art background, so I'm very mystified. You were talking about a term sheet,
yes,
and I don't know what that is, and I don't know how I would create one. So is there templates?
Oh, great. That's a great question, because I think at the start, I had presumed some knowledge of venture capital, so I was going into the nitty-gritty of it and the sausage factory. Term sheet is usually issued by an investor and somebody who is putting a large amount of the capital that you're raising, usually over 50%, into a company. Some companies do issue their own term sheets if it's usually where there's a party around where there's no one large investor to lead the investment into the company. But a term sheet, it's a non-binding, usually, legal document that outlines this is what the company is raising, this is the valuation of the company, so maybe assuming a 20% dilution for ease of maths, 1 on 5 or 2 on 10, so 2 million invested, 10 million post-money, valuation post-money, pre-money. I'm really running through this quickly, apologies. Pre-money is the value of the company before the investment. When you put in 2 million, obviously that goes up to the post-money because you've got what the company's worth plus 2 million in your bank. And it also outlines other legal terms such as, and what will happen to the company after the investment. Usually the lead investor will have a seat on the board. So I view that as a positive because it enables the company and the founder to think with some rigor about what's happening within the company, reporting back to the investor, but it doesn't even have to be reporting. It can be a dialogue, and that's what it often is, saying, okay, we've had problems with this. How do we solve that? If you're just talking with your investors or investor within the board meeting, then you're probably doing it wrong. If anything, you want to have that ongoing dialogue. Other things with the term sheet, yeah, it sets up the lawyers so that they don't spend too much time and spend your hard-earned money on legal fees. So just ensuring that there's a framework. We have the BVCA documents within the UK. There's the MVCA documents within North America and US and Canada for the baseline legal documentations that you use for investments. But just setting, okay, this is roughly how we'll invest, and then we'll kick it to the lawyers, and that will take 45 to 60 days. Was there anything in particular else you wanted to clarify within the term sheet?
Sorry, please use the mic if you can.
Oh, yeah.
You were saying to prepare, prepare
Yes.
the term sheet. So who would I be preparing that with before I go to VC? Like who, do I have to get a lawyer or?
Oh, I'm not able to go back. The prepare part, that's only if you're issuing it yourself, and that's quite unlikely. There are templates which are online. Usually you'd try and have legal counsel for that. They can also help you out. US has some templates as well as UK. I'm less familiar with Poland, I apologize, but there are lots of great lawyers here who will help you with that. Actually, maybe a good guide for negotiations and thinking about term sheets. There is a book called Venture Deals by Brad Feld and Jason Mendelsohn, and it runs through all the different terms that are within a term sheet, how VCs operate, how they negotiate. This is what I actually recommend, even though it arguably is not in our interest, or at least it's potentially shoots ourselves in the foot with having a harder or a worse deal for ourselves. But I think it's better to be honest up front. I recommend that to anybody who's approaching or thinking about fundraising. Get that book, have a read through. The tagline is how to be smarter than your lawyer, and ensures that, again, you aren't spinning too many cycles and that you know exactly what's going into that legal documentation.
Hey, Rafał from Fra Games, and I have a question. You mentioned looking for an internal champion within the organization. Yeah, so would you mind sharing any tips how to find one, especially in a case where your first meet was a miss?
Politics is within every organization. So trying to find another champion within a firm that maybe has already passed on you is difficult. Ideally, you have an organic process with another person that you meet up at an event, you see where they're going, not in a stalkerish way, and that you start chatting with them. You're able to come back with something that's changed or updated for the better, that we made this progress with the game or the product, that we've had this revenue, that we've had this interest, so that they reevaluate it rather than just coming back and saying, hey, we're raising again, but nothing's changed. Then as for the speccing out of who you should approach, there have been arguments within venture capital on this, because technically, the more senior you go, the more decision-making power that you have, but also the less time they have, the more biases that they also have, that they've seen it and either will go yes, no on things, and usually it's no. So I think there's some value in going mid-layer, either principal myself or to associate. I wouldn't turn down those opportunities to be introduced and chat with them, because they've got more time. It's more significant for their career. Again, this is on the politics side. If they lead a deal, if they bring something to the partners. So ideally, you convert somebody within that. You look at their past history, whether it aligns well with what you've done, and also look at talks that they've given, articles that they've written. Do they say the same thing as what you're trying to pitch? It's also a good sign if you actually flag that up, say, hey, I read this, and we're basically saying the exact same thing, as long as you're not completely pandering to the audience. Oh, time's up. So it just shows that you've done your research and that you're a smart and resourceful founder. So yeah, that's all the recommendations I've got.
Can I have one more question?
The time's running out, but we'll have, if it's a short one, we can have this one and the short answer as well.
So you talked about like the specifics of like what to do and what not to do, how to prepare and so on. Are there any like trends that, let's say, there are ideas that you're already going to kind of dismiss as you're listening to a pitch, or does it strictly come down to innovation and all those other things that you talked about?
I like to think that I'm not too prejudiced. I won't dismiss anything quickly out of hand. I think there are very difficult markets, red ocean markets, like pure gaming content. You're doing a match-3 game there. Okay, even though that's a largish market, there are also just so many large incumbents, and you're fighting against that marketing spend. Esports as well. We haven't invested directly into that. I think it's very difficult to scale a venture scale business. Those are more of the things where it's very challenging to get a pitch right. Some areas of interest, I mentioned before on gamified apps, AI is quite interesting, but more on the user side rather than for big companies to cut employees. I'm not interested in that, both ethically and personally, but also that's not changing the game. That just lines the pockets of larger companies. I don't think startups can really compete maybe over a couple of years with product enhancing innovations. AI might unlock something on the distribution side with streaming and multi-platform stuff. Again, I said that I wouldn't pitch you what I'm interested in, but those are some things, and I will stop there so that I can allow everyone to flip the room. Thank you so much.
Thank you once again.